Today, we are diving deep into one of the absolute cornerstones of finance, the time value of money. It's this idea that sounds super simple, right? The money you have right now is worth more than the same amount of money in the future. But understanding this is, seriously, the key to making way smarter financial choices. So let's get right into it.
Okay, let's kick things off with a quick question. Imagine someone offers you $1,000. The only catch, you have to choose get it right now, this very second, or wait 3 years to get that exact same $1,000. What does your gut tell you to do?
I'm willing to bet almost everyone, without even thinking, says give me the money now. And you know what? That instinct is spot on. But the really powerful part isn't just making the choice, it's understanding the why behind it. That logic is the foundation for everything from how you build your own wealth to how Wall Street values massive companies.
So here's how we're going to break it all down. First, we'll establish why a dollar today is just different. Then we'll look at the engine behind all this, the magic of compounding. We'll get into the two main ways we look at this stuff, future value and present value. After that, we'll tackle annuities, which are just regular payments over time. And to wrap it all up, we're going to put it all to work in a real-world scenario.
All right, first things first, we've got to lay the foundation. Let's really get into why a dollar today is fundamentally different from a dollar you get tomorrow.
So what do we actually mean by the time value of money? Well, it's pretty simple. It's the idea that the money you have right now has earning potential. You can put it to work. You can invest it, it can earn interest, and it can grow into a bigger pile of money down the road. That potential to grow is exactly what makes today's money so much more valuable.
In this, right here, this is the mantra. If you take away just one thing today, let it be this. Seriously, burn it into your brain. A dollar today is worth more than a dollar tomorrow. It's not just a cute saying. It's basically a law of finance. A dollar in your hand right now just holds so much more opportunity than that same dollar in the future.
Okay, so if today's money has all this earning potential, what's actually making it grow? Well, that leads us right into Section 2, the power of compounding. You can think of compounding as the turbocharged engine that makes this whole time value of money concept fly.
Now, check out the huge difference here. With simple interest, you earn interest only on the money you first put in. That's it. It's predictable, but kind of boring. But compound interest, oh, that's where the magic happens. You earn interest on your initial money, and you earn interest on the interest that's already built up. It's like your money starts having its own little money babies, creating this incredible snowball effect.
You know, talking about it is one thing, but seeing it in action really makes it click. So let's use a quick example from our source material about an investor named Cindy Johnson to see just how powerful this really is.
Okay, so Cindy puts $1,000 into an account paying 10% interest, compounded every year. After year one, simple enough, she gets 10% of that 1,000, which is $100. Her new balance is $1,100. But here's the cool part. In year two, the interest isn't on the original 1,000 anymore. It's on the new balance of $1,100, so she earns $110. Then in year three, it's on $1,210, so she earns $121. See? That snowball is picking up speed.
And just like that, after only 3 years, her $1,000 has turned into $1,331. That extra $31 that she wouldn't have with simple interest, that is the power of compounding right there. It's the growth on the growth.
This whole idea leads us perfectly into our third section, future value versus present value. These are basically the two main tools we use to measure the time value of money.
The easiest way to think about this is that they're two sides of the very same coin. Future value is all about looking ahead. It answers the question, hey, if I invest this money today, what's it going to grow into later? Present value, on the other hand, looks backward. It asks, I know I want a certain amount of money in the future. So what is that promise of future money actually worth to me right now, today?
And if we look back at Cindy's example, it becomes crystal clear. That $1,000 she started with, that was its present value. And after 3 years of growth, its future value became $1,331. It's the exact same value, we're just looking at it from two different points in time.
So getting from one to the other is all about interest. To find the future value, we're compounding. We're adding interest forward through time. To find the present value, we're doing the opposite. It's called discounting. We're basically removing all the interest that would have been earned to figure out what it's worth today.
Okay, so we've been talking about single chunks of money, right? A one-time investment. But what happens when you have a whole series of payments? Well, that brings us to Section 4, annuities.
An annuity is just a fancy word for a stream of identical payments that happen at regular times. I mean, think about it. Car payments, a mortgage, or even you putting away $100 every single month for retirement, all of those are annuities.
Now, the really important thing with annuities is timing. For an ordinary annuity, the payment happens at the very end of the period. But for an annuity due, it's at the beginning. And that tiny little difference has a huge impact. An annuity due is always going to be worth more. And it's because every single payment gets one extra period to sit there and earn interest.
All right, time to put it all together. In our final section, we're going to see how all these concepts, present value, future value, annuities, and compounding, all team up to solve a pretty complex but very real financial problem, figuring out the value of a corporate bond.
So here's the situation from our source material. A company, Fumatsu Electric, issues a big $200 million bond. It promises to pay a 10% interest rate. The catch is, when they issue it, the going rate for similar bonds out in the market is actually 12%. So the big question is, what would an investor actually be willing to pay for this thing?
To solve this, we just have to break it down. A bond is really just two separate things combined into one. First, you've got that stream of regular interest payments. Hey, that's our annuity. And second, you have the big lump sum payment at the very end when the bond matures. All we have to do is calculate the present value of the annuity, calculate the present value of that final lump sum, and then just add the two together.
And after you run all the numbers, the present value, the fair price an investor should pay for this bond today, is just a little under $170 million.
So wait a minute, why wouldn't it be worth the full $200 million? This is the time value of money, live in action. Think about it. A smart investor knows they can go somewhere else and get a 12% return. Since this bond only pays 10%, it's less attractive. So they aren't going to pay full price. They will only pay a lower, discounted price that makes their actual return on investment equal to that 12% they could get elsewhere. That $30 million difference, that's the price of time and opportunity.
You see, from saving for retirement to figuring out a loan, the time value of money is absolutely everywhere. It's a constant reminder that every single financial choice you make isn't just about how much money is involved, it's about when that money shows up. So the real question to ask yourself is, now that you get this, how is this powerful idea going to change the way you look at your own financial choices?